Hey everyone, welcome back to our channel. Today we've got an exciting video lined up for you about monetary policy and interest rates, so let's dive in. Monetary policy and interest rates are two of the most important tools used by governments and central banks to influence economic activity. These policies determine how much money is circulating in the economy, how accessible that money is, and ultimately, how fast an economy grows or contracts. While they may seem abstract, the decisions made about monetary policy and interest rates have a direct impact on everyday life, from the cost of borrowing money to the availability of jobs. In this video, we will explore what monetary policy is, how central banks use interest rates as a tool, the different types of monetary policy, and how these policies affect the broader economy. By understanding the basics of monetary policy and interest rates, you can gain insight into how financial systems work and how economic decisions affect your personal finances. What is monetary policy? Monetary policy refers to the actions taken by a country's central bank or monetary authority to manage the supply of money and achieve specific economic objectives. These objectives typically include controlling inflation, stabilizing the currency, promoting employment, and encouraging economic growth. The central bank of a country, such as the Federal Reserve in the United States, the European Central Bank (ECB), or the Bank of England, is responsible for implementing monetary policy. The tools they use include setting interest rates, controlling money supply, and regulating banks. There are two main types of monetary policy: expansionary and contractionary. Expansionary monetary policy is used when the economy is in a slowdown or recession. The central bank increases the money supply and lowers interest rates to stimulate economic activity. Lower interest rates make borrowing cheaper, encouraging businesses to invest and consumers to spend, which boosts economic growth. Contractionary monetary policy is implemented when the economy is growing too quickly, leading to concerns about inflation. In this case, the central bank decreases the money supply and raises interest rates. Higher interest rates make borrowing more expensive, which cools down economic activity and helps control inflation. The primary goal of monetary policy is to achieve a balance between economic growth and inflation. If an economy grows too quickly, it can lead to rising prices or inflation, which erodes the purchasing power of money. If an economy grows too slowly, it can lead to unemployment and stagnation. The role of central banks in monetary policy. Central banks are at the heart of monetary policy decisions. They are independent institutions that have the authority to influence a country's money supply and interest rates. By controlling the cost of borrowing, central banks can either encourage or discourage spending and investment in the economy. The Federal Reserve Fed in the United States, for example, has a dual mandate to promote maximum employment and stable prices. Similarly, the European Central Bank (ECB) aims to maintain price stability across the Eurozone. Central banks have several tools at their disposal to implement monetary policy. Open market operations involve the buying and selling of government securities in the open market. When the central bank buys securities, it increases the money supply in the economy, leading to lower interest rates and stimulating economic activity. Conversely, when the central bank sells securities, it reduces the money supply, leading to higher interest rates and cooling economic activity. Reserve requirements refer to the amount of money that banks are required to hold in reserve and not lend out. By changing reserve requirements, central banks can influence the amount of money banks can lend, thereby controlling the money supply. Lowering reserve requirements allows banks to lend more, increasing the money supply. Raising reserve requirements restricts lending and reduces the money supply. The discount rate is the interest rate that central banks charge commercial banks for short-term loans. By adjusting the discount rate, central banks can influence the cost of borrowing for banks, which in turn affects the interest rates that banks charge their customers. Lowering the discount rate makes borrowing cheaper, while raising it makes borrowing more expensive. Central banks can also influence monetary policy by paying interest on the excess reserves that banks hold at the central bank. By changing the IOR, central banks can encourage or discourage banks from holding excess reserves, thereby affecting lending and the money supply. Interest rates, the key tool of monetary policy. Interest rates are perhaps the most visible and widely discussed tool of monetary policy. The interest rate set by a central bank, often referred to as the policy rate or benchmark rate, serves as the foundation for all other interest rates in the economy, including mortgage rates, car loans, and savings account rates. The two primary types of interest rates that central banks focus on are: the nominal interest rate is the stated or advertised rate without taking inflation into account. For example, if a bank offers a loan with a 5% interest rate, this is the nominal rate. However, if inflation is 2%, the real cost of borrowing is effectively lower because inflation reduces the value of money over time. The real interest rate is the nominal interest rate adjusted for inflation. It reflects the true cost of borrowing and the real return on savings. For example, If the nominal interest rate is 5% and inflation is 2%, the real interest rate is 3%. Central banks pay close attention to real interest rates because they have a direct impact on consumer behavior and economic activity. When central banks lower interest rates, borrowing becomes cheaper. This tends to stimulate spending and investment, leading to economic growth. However, if interest rates are too low for too long, it can lead to excessive borrowing, asset bubbles, and inflation. Conversely, when central banks raise interest rates, borrowing becomes more expensive. This cools down spending and investment, which can slow economic growth but also helps control inflation. How changes in interest rates affect the economy. Interest rates influence almost every aspect of economic activity, from consumer spending and business investment to the housing market and exchange rates. When interest rates are low, consumers are more likely to borrow money to finance large purchases such as homes, cars, and appliances. This increased spending stimulates economic growth. However, when interest rates rise, borrowing becomes more expensive, and consumers may cut back on spending, leading to slower economic growth. Businesses often rely on loans to finance new projects, expand operations, and purchase equipment. Lower interest rates reduce the cost of borrowing, encouraging businesses to invest and grow. Higher interest rates, on the other hand, increase the cost of borrowing, leading businesses to scale back investment. The housing market is particularly sensitive to interest rate changes. Lower interest rates make mortgages more affordable, leading to increased demand for homes and rising home prices. Higher interest rates make mortgages more expensive, which can reduce demand for homes and slow down the housing market. One of the central goals of monetary policy is to control inflation. When interest rates are low, there's a risk that too much money will flow into the economy, causing prices to rise. By raising interest rates, central banks can reduce the money supply and keep inflation in check. Interest rates also affect a country's currency value. When interest rates are higher in one country compared to others, foreign investors are more likely to invest in that country to earn higher returns, leading to an increase in demand for the country's currency. This can strengthen the currency's value. Conversely, lower interest rates can weaken a currency as investors seek better returns elsewhere. The challenges and limitations of monetary policy. While monetary policy is a powerful tool, it is not without challenges and limitations. Central banks must carefully balance the trade-offs between promoting economic growth and controlling inflation. Too much stimulus can lead to inflation and asset bubbles, while too much tightening can stifle growth and lead to unemployment. Another challenge is the lag effect of monetary policy. It can take months or even years for changes in interest rates to fully impact the economy. This makes it difficult for central banks to time their policies perfectly. Additionally, central banks are not the only players in the economy. Fiscal policy, implemented by governments through taxation and spending decisions, also plays a crucial role in shaping economic outcomes. Sometimes, monetary policy and fiscal policy can work at cross purposes, complicating economic management. Monetary policy and interest rates are fundamental tools used by central banks to influence the economy. Through actions such as adjusting interest rates, controlling the money supply, and regulating banks, central banks can either stimulate or cool down economic activity. The effects of these policies are far-reaching, influencing everything from consumer spending and business investment to inflation and exchange rates. Understanding how monetary policy works can help you make more informed financial decisions, whether you're planning to buy a home, invest in the stock market, or save for retirement. While monetary policy is complex and has its limitations, it remains one of the most powerful levers for managing the economy and ensuring long-term stability.